Jamie Dimon, the CEO of J.P. Morgan Chase, recently said he wouldn't buy stocks or treasuries at current prices, and that markets are underestimating the risks out there. That's a striking thing for the head of one of the world's largest banks to say out loud. But here's what's more interesting than the headline itself. Why do powerful investors make statements like this? What do they actually mean when they do? And should you change anything about how you think because of them? That's what this video is really about. Dimon's comments came at a moment when many investors had shown a remarkable willingness to look past a long list of concerns. Wars, tariffs, and other shocks that in earlier cycles might have rattled markets more visibly. His view contrasted sharply with that prevailing mood. He wasn't predicting a crash. He wasn't giving a timeline. He was simply saying in plain language that he personally wouldn't be a buyer at these levels, and that the risks embedded in the current environment are being underestimated. That's the news peg. But the mechanism behind it, the way senior financial figures use public statements to signal valuation concerns, and the way markets and observers interpret those signals, that's a story as old as Wall Street itself. So, let's dig into it. To understand what's really happening when someone like Dimon speaks, you have to understand the role of what analysts call a market signal. A market signal is any piece of information that a sophisticated actor communicates, sometimes deliberately, sometimes not, that causes others to update their expectations. Signals come in all shapes. A central bank raising rates is a signal, a company buying back its own shares is a signal, and a prominent CEO saying he wouldn't touch certain asset classes at current prices. That's a signal too. The question is always the same: what kind of signal is it? How reliable is it? And what does the person saying it actually know that you don't? Now, Jamie Dimon isn't just any executive. J.P. Morgan Chase is one of the largest financial institutions in the world, with visibility across lending, trading, investment banking, and global capital flows. When someone in that seat makes a public statement about valuation, it's reasonable to ask whether they're seeing something in the data that the rest of us aren't. But it's equally reasonable to ask whether a public statement of this kind is even the right vehicle for an investment thesis, and whether the incentives of the person speaking align with yours. That tension is at the heart of this mechanism. Here's how it actually works. Senior financial figures, central bankers, major fund managers, bank CEOs, operate in a world where their words move markets. That creates a peculiar dynamic. On one hand, they have access to enormous amounts of economic data, credit flow information, and institutional positioning. On the other hand, they have constituencies. A bank CEO has shareholders, regulators, clients, and employees. A fund manager has investors who need to feel confidence in their portfolio. A central banker has an entire economy watching for signals of panic or calm. So when any of these figures speaks publicly about valuation, about whether something is cheap, expensive, or dangerous, their words are never purely analytical. They're also strategic. That doesn't mean the analysis is wrong. It means you have to hold both things at once: the content of what they're saying and the context in which they're choosing to say it. The mechanism itself has a few distinct phases. First, there's the statement. A high-profile figure expresses a view on the price of an asset or the level of risk in a market. Second, there's amplification. Financial media picks it up, headlines get written, and a much wider audience encounters the view. Third, there's interpretation. Analysts, traders, and ordinary investors try to decode what the statement means, whether it implies action, and whether the speaker has information advantage. And fourth, and this is the part people often miss, there's the drift, where over time The statement either gets validated by events or quietly fades without consequence. The uncomfortable truth is that most public valuation warnings, even from very credible sources, don't map cleanly onto actionable investment decisions. The timing is almost always absent. The specificity is almost always vague. And the speaker almost never commits to a position that can be tracked and measured. What these statements do accomplish, and this is genuinely valuable, is they inject a note of caution into a conversation that might otherwise be dominated by momentum and optimism. They slow down the narrative. They remind market participants that prices are not destiny, and that the gap between current prices and underlying fundamentals is always worth examining. In an environment where investors have been shrugging off geopolitical risk, trade disruptions, and macroeconomic uncertainty, a senior figure saying out loud that he thinks risks are being underestimated performs a specific function. It gives permission to the skeptics, and it puts the optimists on notice. So what actually happens when signals like this enter the market? The honest answer is, it depends. In the short run, statements from figures with genuine credibility and institutional weight tend to attract attention and generate discussion, but they rarely cause dramatic, immediate repricing on their own. What they do is contribute to what you might call the sentiment backdrop, the general mood that sits underneath day-to-day price movements. When that backdrop shifts from confident to cautious, the threshold for bad news to move markets gets lower. A piece of data that might have been brushed off in a risk-on environment starts to land harder. A geopolitical development that investors had been looking past suddenly gets more weight. That's the real transmission mechanism, not a direct cause and effect between the statement and a price move, but a gradual recalibration of how market participants are weighing information. For individual investors, the more practical impact is psychological and procedural. A credible warning from a respected source is a reasonable prompt to revisit your own assumptions. Are you holding assets because you genuinely believe in their value at current prices? Or because they've gone up and that feels like validation? Are you discounting certain risks because they haven't materialized yet, or because you've genuinely analyzed them and concluded they're manageable? These are the questions that statements like Dimon's are most useful for prompting. Not as instructions, not as forecasts, but as prompts to think harder about your own reasoning. There's also a broader market structure impact worth understanding. When multiple credible voices begin to converge on a similar concern, when it's not just one person saying risks are underpriced, but several across different institutions and vantage points, that convergence starts to carry more weight. One voice is a data point. Several voices form a pattern, and patterns, in markets, have a way of becoming self-fulfilling, not because the voices are always right, but because enough participants begin to act as if they might be. So let's classify what we've actually seen here, and what it means for how you should interpret moments like this going forward. What Dimon expressed is what analysts call a valuation warning with a risk sentiment dimension. It's not a forecast of a specific event. It's not a recommendation tied to a time frame. It's a statement that, in his judgment, the price being paid for certain assets doesn't adequately compensate for the risks that exist in the environment. That's a legitimate and important category of market commentary, and it's distinct from panic, from prediction, and from advice. The broader pattern this fits into is one that repeats across market cycles, a period of investor resilience where bad news gets absorbed without major repricing eventually produces a divergence between institutional caution and retail or momentum-driven confidence. Senior figures with broad data access start to express discomfort. the mainstream narrative remains bullish. And at some point, with timing that no one can reliably predict, those two views have to reconcile. History doesn't tell us when that reconciliation happens. It does tell us that it always does. The lesson isn't to panic when someone like Dimon says he wouldn't buy. The lesson is to use moments like this as a stress test for your own portfolio logic. Not because he's always right, he isn't, but because the discipline of pressure testing your assumptions is always worth the time. That's the mechanism. That's the signal. And that's what separates investors who think clearly from those who simply follow the mood. If you found this useful, subscribe to Investors Club Global for more videos that explain the mechanisms behind the headlines, the kind of thinking that stays relevant long after the news cycle moves on. Hit the like button if this gave you a new way to think about market signals, and drop a comment below. We read them all.